Many people talk about how to hedge a portfolio, and very few people do it correctly. We talk about how to hedge things. We buy puts. We just aggressively buy directional calls or directional puts and think that that's actually hedging a portfolio when it's really not. So I want to talk about how you can actually hedge your portfolio successfully, especially if you're a small account. Now, specifically speaking in the realms of hedging, we'll define it really quick on what hedging actually is. And hedging is basically preparing for the inverse of what your portfolio is positioned for. Most people are positioned long equity, right? So for the sake of this conversation, we're going to focus simply on a long equity portfolio. So, and I'm actually going to use an example from our community exclusive trading. It's our Seed to Tree program, which is essentially like a small account program. Currently, that account's sitting at around $4,000. So I want to use that as an example so you guys understand kind of how to apply it to your own trading and how to hedge appropriately. So this portfolio is sitting at about $4,000, and I would say roughly 80% of the portfolio is allocated to long equity. And I would say roughly 1% of the portfolio, maybe 2%, is allocated to a bear position. Here's why. If the market is still structured bullishly in general, even if there's a period of pullbacks like we've been seeing the last few days, I want to prepare myself to capture as much gains as possible. But if I'm doing the number one rule of what I share with you guys on this program, on my channel, on our Discord community, not lie to myself, I also need to say, things may be a little overheated, things may be a little hot to the upside. I should probably buy some protection, which is actually how you're supposed to use options in the first place. A lot of people trade options. I trade options myself for a living. But options are actually supposed to hedge your long equity, essentially. That is how you should be using options, and not everyone does that. And myself included, I don't do that either. I buy options to make money, right? I trade them back and forth, whatever. But when you're talking about a portfolio, and again, we're using this $4,000 portfolio as an example, and we'll say, like I said, 80% of the portfolio is roughly long equity. Now, in my scenario, most of this equity is actually profitable. So essentially, I'm putting stops on at above my break even. So I'm only losing opportunity cost, meaning if I'm putting stops, let's just say use simple numbers, at 10% and everything's trading at a 20% gain, even if things come down, I'm stopping out at 10% gain. So I still made 10% over my original entry. That's good. Yes, I did lose 10% gains, but I still made that 10% on the original start of the position. So long term, that's a good thing. Let's start there. Now, if I want to actually hedge myself for any potential downside in the market, you want to take an offside, lopsided bet on the market. What do I mean by that? Well, me personally, I took last week when the market hit its high, literally at the close of this candle here on 9/22, I actually opened up a put debit spread. A 650, hold on, let me just double check before I misspeak. I opened a 650, 649 put debit spread. And I opened in this scenario 5 of them for 19 cents a contract. So that means I'm putting $100 on the line. We'll round it to 20. So I put $100 on the line for this trade. Now, if this trade goes to a full profit, I make $400 in gains because it's a $1 spread. I bought it at 20 cents. The max it's worth could be $1. So the max I can make is $400 on this one trade. It's a lopsided bet, and the most I could lose is $100. So I have a 4-to-1 risk to reward profile on this trade. Now, in the event the market takes a dump, like I just said, all of my long equity will get stopped out. So when we're seeing an overextended move, you want to start using stops on your equity trades. You want to be very careful, put those stops in, lock everything in that you can. You are giving up that opportunity cost, so that you have to calculate on what that is really worth to your portfolio. So yes, you may lose 1% of potential gains in your portfolio. So in this case, let's say if all my stops trigger on the 80% of my equity, and let's say I lose $200 to $300, again, theoretically, of potential gains, right? Because this is just extra gains. Then the put debit spread that I had, which if I cash it out at full value, in this case, all theoretically, I would actually make a $100 gain overall during that time period of volatility. And most importantly, I'm sitting all cash now. So as all my positions get stopped out, now I'm cash. Now I can go out and buy while the market's dumping, or take advantage of new positions that hit key supports and buy and reposition myself, or the names that I really like that had a lot of great momentum that just had some downturn on it that got stopped out. Maybe they got even lower and I still really like these names and I want to get back in. Now I have a better average or a better entry, whatever it may be. And I protected my cash and I actually made a gain still. Now, what you don't want to do, well, actually, before we say what we don't want to do, let's go into the opposite scenario where it doesn't work out, meaning the hedge doesn't work out. So like I said, the 80% of the portfolio that's still long equity, and again, we're theorizing that 20% sitting in cash, just for simplicity's sake. 80% of the portfolio that's long equity, the market continues to rise, right? Now I'm losing, that put debit spread goes worthless, right? So now what was $100 is now worth $0. So I lost all my money there. But again, this is all in theory. If those 80%, that whole 80% of my portfolio continues to the upside, and again, we're using this $4,000 portfolio as an example, so we'll just say, it's not exactly, well, actually here, I'll get the exact number. 4,000 times 8. So we'll just say $3,000. It's $3,200, but we'll say $3,000. If that $3,000 at least appreciates, what, 1%? Not even, 0.03%. So if all of my equity, everything, at least goes up 0.03%, I have fully covered my put debit spread, because that would be a $100 gain. So as long as all the stocks, for more simplicity, if they go 1%, I've now made $300 on my equity. Again, unrealized gains, but $300 on my equity with a $100 loss on my put debit spread. I still net out a $200 positive. So no matter how you slice it, when you take a lopsided bet on the market intentionally to hedge a portfolio, that is the way you do it. You do not want to take directional puts unless you know what you're doing, because a lot of the times bears get wrecked. A lot of the times. Bears get squeezed, bears get wrecked, bears get overconfident. And how typically the market works is the market likes to reward bulls slowly. As I like to say, bulls take an escalator while bears take an elevator, right? As a bear trader, you typically get your gains pretty quick. As a bull trader, it might take some time, right? Sometimes you get explosive moves, short squeeze, etc. But typically, bear moves tend to be sharp and rapid, and bull moves tend to be a little slower. So as a result, you intentionally want to take an offside or a lopsided bet that is a bearish bet on the market to hedge your portfolio, because if you're still betting that the market may kind of go stair step its way up, the money you're making on your equity is actually going to offset the cost of that bear position. Now, if you wanted to take a larger bear position or a more aggressive bear position, where in that case, let's say you buy a put debit spread that is 50 cents versus 20 cents, you could do the same thing and just take fewer contracts. But if you took the same amount of contracts, now I'm betting, again in this scenario, $500, and the risk to reward ratio is very different. Now I have a 1-to-1 risk to reward scenario on the spreads, and for my portfolio to cover the cost of the spreads, I now need almost a 2% gain to offset the loss behind the put debit spread. So as you can see with that real quick, simple math, taking in this case, a cheaper spread is actually more beneficial in this scenario, because it can yield a wider, larger return. And if you're actually hedging appropriately, that is a more favorable position to take versus a closer to the money bear position, unless you're trading, again, you know what you're doing, whatever. But for most people, most retail traders who are long equity, taking specifically a bear spread, a put debit spread, is the way to go with the right risk to reward ratio. So that's how you should consider hedging your portfolio appropriately. The amount of the spread or the amount of the bear position, whatever you want to do, should be able to offset the opportunity cost of the equity. That is very important. If it can't offset the opportunity cost, then you're doing it wrong, or at least come pretty close, right? Otherwise, don't hedge. If you don't know what you're doing, don't hedge. Just put your stops on and ride it out, man. Because a lot of the times people put way too much money in when they're hedging because they're preparing for downside, and they lose hundreds of thousands of dollars because they just buy puts recklessly and they don't know what they're doing. But when you look at the potential opportunity cost, how much am I thinking my equity is going to make, or how much would my equity have to make to offset this bear trade, and how much would the bear trade have to make to offset my opportunity cost that is lost, right? Realized gains that are realized lower, to offset that difference to at least net my portfolio out in the green. That is how you can hedge yourself successfully when the market gets a little more volatile.